Hello friends, I am Dr. Rusbek Bodanwala and today we'll learn the risk and return framework of investing in penny stocks. Are you an investor who feels comfortable buying 100 shares of XYZ company which is available at Rs 30 but are afraid to buy one share of TCS which is selling above Rs 3000? Are you an investor who feels that there are greater chances of appreciation in share price of XYZ which is let's say available at 10, 20 or 30 as compared to the appreciation in the price of TCS which is available at Rs 3000? If you think this way, it will be interesting for you to learn more about the risk and return framework of investing in penny stocks as compared to large cap stocks. In this study, we have captured price data from 1st of March 2010 of all the listed companies. In 2010, we have studied close to 2000 companies and applied two filters. Those filters are that the ROE, return on equity, should be greater than 10%, and the second filter was that at that point of time, the market capitalization of each company should be over 100 crore. So this filter was applied so that we don't end up buying stocks which are absolutely illiquid penny stocks. As you can see, if a portfolio is created in 2010 using these two filters, there are close to 661 companies which qualify. Those 661 companies were divided into 5 portfolios on the basis of their price levels. So, the first decile 1 that you see on the screen is consisting those stocks which are of relatively higher price, and the decile 5 are those stocks which are relatively smaller in terms of price, or we can call it as penny stocks. Now, as you can see that the average return of decile 1 has been close to 12%, whereas the average return of decile 5 is the highest among all these categories and it is close to 30%. This tells us that if the holding period is 1 year from 2010 to 2011, penny stocks would have given you a much higher return as compared to stocks which are of larger price. Now, as compared to the Nifty 50 returns of 12%, the 30% which an investor would get by investing in penny stocks is almost 2.5 times. Now let's see how the portfolio formed using the same logic would have generated returns if the investment were made on 1st of March 2011 and the holding period was 1 year. Now in this year, as you can see, 690 stocks qualified and the decile 1 generated a return of 6%, which is higher than 3% generated by penny stocks. So the stocks which had relatively higher price levels were able to generate a 6% return, which is higher than the Nifty returns of minus 3%. We carry out this study over the period from 2010 to 2020, and as you can see, the portfolio which has generated the highest return is indicated in the color green. And as we can observe, the decile 5, which contains the penny stocks, has generated much more return than relatively other categories, except for 2011, 2018 and 2019. Now, we clearly observe that the average returns of investing in penny stock is higher. But now let's look at the risk of investing in penny stocks versus stocks which are of higher price levels. The second table on your screen is nothing but the standard deviation of the price returns. If you observe the green shaded area, which represents the standard deviation of investing in penny stocks, is the maximum. So in 2010, the standard deviation of returns of investing in penny stock is as high as 0.71 as compared to the standard deviation of investing in higher price stocks, which is close to 0.46. In 2020-2021, standard deviation of investing in penny stocks is again the highest 0.81 versus the standard deviation of investing in the stocks which are of relatively higher price, which is close to 0.42. So what does it all summarize? What we can summarize is that yes, penny stocks can generate higher returns, but the risk levels are also very, very high. So my friends, we have some suggestions for you. Do not invest too much in penny stocks, as penny stocks are rewarding but at a great risk. Invest in only a handful of them and track them regularly. Prefer stocks with higher volumes so that it is easy for you to enter and exit. After you purchase a stock, if the stock falls, please consider revisiting the fundamentals and, if possible, book losses and do not get anchored to the price point. Lastly, if you are successful, please don't get carried away and increase your portfolio allocation in penny stocks. Thank you for watching. Please share it with your friends. Have a good day.